Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim, and a happy Friday to you.
Bob, choppy New York stock market. We see a couple of days of advances and then some sharp declines. What's happening there?
Oh, yeah. It's been a very good run out of Christmas. And you recall that last year we were noted the degree of speculation, which was measurably incredible. Valuations for the stock market were exceptionally high. And so, typically, if it goes wrong, it'll go wrong in the fall, and that's where we were positive out till June when we called the market forces sunshine. And then we expected in August that it would turn to twilight, with the possibility in the fall of discovering the old scary program, the Twilight Zone, which happened. And then within that, in a fall problem in the financial markets, often they can sort of clear by November, but the 1825 bubble disaster didn't clear until Christmas, and that's what happened with this one. It was a heavy-duty liquidity problem, and it cleared at Christmas, and you had weak crude oil, which we were expecting. You had weak base metals, which was probable. So, and changes in the credit markets that were appropriate. So it was a whole across-the-board liquidity problem. And then, of course, right at Christmas, everything got oversold. So then we were looking for the bounce, and it's been a good one. And for the last couple of weeks, our measures were quite overbought. And it sort of hung there for a couple of weeks, and then finally here it's correcting. And that's what this is likely to be, because our basic theme with the hit down to Christmas was that the rebound could run out to around March, and that would be, based on certain seasonal things and stuff like that, plus a little intuition. But a correction now, Jim, and then a rally out to around March. Hey, we're into the 8th of February already, so let's say 4-5 week rally. And then when we get there, we'll take a look and see whether there are any excesses or whether there are any threats developing. But underneath it, there are some serious threats, because that was a long bull market, and it ended with a spectacular climax, and it had characteristics of previous classical bubbles, such as 1929 or 1873, or we already mentioned the 1825 bubble. And one of the wisest comments ever read in anything printed on the financial markets, like reporting newspapers, or in this case it was The Economist publication in as the bubble of 1873 crashed, and the writer, who was anonymous, wrote that while the panic may be over, the results of the panic are not over. And that's what we look at here. We've had a hit that could be called a panic. We're getting a rebound, and the changes in the credit markets are such that it's a caution. And the path on the way up the bubble was very similar to 1929 or 1873, where you have really good data. And the conclusion was similar. All of the previous great financial bubbles in history suffered liquidity problems in the fall and then bounced around for a while and eventually rolled over. The setback to the financial markets, the boom, Jim, was tied to financial speculation. So if the financial speculation is diminishing, and it is, then it goes that the business activity would also be diminishing. Now, of recent, like the last couple of years, really perked things up. And you look at it, in the U.S., a lot was with the reduction in taxes and corporate money being parked out of the U.S. coming back home. And it brought employment figures down to exceptional lows. But then you take a look. In Canada, employment number got down low. In Europe, it's down low. And so it's not totally Trump and reducing taxes and freeing up business in the U.S. I think that would help other economies, but it looks like kind of a natural conclusion to a very long bull market, and mind you, most of it since the disaster of 2009, as measured in the United States, was a bit of a slow recovery, but it ended up with a robust economy and an unbelievable stock market. So, how do you work your way out of that? You've got excessive prices and excessive speculation, and one of the leading economists in the 1920s, Irving Fisher, he had a theory on that bull market that you would get a strong rise, then a setback, and then it would hold the plateau from which then the next rise would start, and that described the 1920s, but he didn't have the ability to determine what was the last rise, and there was the last rise, and even after it went down, he was still pushing his story about a plateau, build a base, and then another leg up, and he was long. So not only did his reputation as an economist suffered, but his pocketbook suffered as well. And then eventually later on he realized there was a major change going on. So these market history is fascinating.
We'll have more with Bob Hoye right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, do you think U.S. Fed Chair Jerome Powell is going to put the brakes on interest rate hikes?
That's always a good one. And you got two kinds of interest rates out there. You got market-driven rates of interest, like the T-bill, Treasury bill, either 3 months or 6 months, and it trades all the time, continuously, up and down in yield. And then you have the central bank with its administered rate. So the myth is that the central bank can set interest rates, and then that's always going to make the economy good, and it can also prevent setbacks. Now, the Fed was formed it started business in January 1914, and part of the intention of having a central bank was that as a lender of last resort, it would then prevent the financial setbacks that preceded recessions. So you look at the history, and there's been 18 recessions since the Fed started in 1914. So the theory doesn't work. But then so here, you got a double thing going on here, Jim, because one, they say they can make the economy better by their manipulations. And then two, if there is they can prevent setbacks. And then three, when there is a setback, they roll in, and then the heavy liquidation ends, and then they claim that they ended it. If they didn't move by lowering rates, then the panic would last forever, which of course is impossible. So it's a farce. The idea that a central bank can manage a national economy. One thing, there's no such thing as a national economy. Can you imagine that Canada's economy is independent of the American economy? Heh. And yet you've got a central bank in Ottawa thinking it can run the economy. It's a form of madness. So this is where I look at, if this does work out, post-bubble contraction, then it'd be one more failure by the theories of intrusive economics and intrusive central banking, and I think the public's going to notice that. And also in the United States, the public's going to notice that the central bank spent trillions of dollars, and they would be ultimately taxpayer dollars, in trying to prevent bad things from happening. And if we're into, at some time later in the year, a very slowing economy and not so good stock market, that could be described as a bad thing, and the public is going to say, hey, all your theories are not working. So I think we're in a period where there can be, hey, let's call it a new bull market for common sense, where the public says, all of this intrusion doesn't work, get out of my life. And what it essentially is, Jim, the policy of intrusions, there are many different kinds, but it comes down to in-your-face government and in-your-wallet government. And they get to tell you what to do, and you pay them for telling you what to do. It's a form of madness, but it sort of came on so subtly and slowly over so long that it's accepted. And of course then there's the other one out there, which is newer, and that's the idea that a group of busybody can set the temperature of the nearest planet on this global warming thing. And of course this week, the Green New Deal in the States was announced, and all it is a form of communism, socialism, with the selling point that they can control the climate. And that's an audacity that's normally attributed to Greek gods, for example. So it's been a very interesting week. Now, what we want to look here is for an opportunity on the long side. When you're into a potential bear market, of course, you want to sell the rallies, whereas hitherto in the bull market you buy the dips. And our springboard buy model has been very good at identifying those dips. And then it's been modified now to in the big bull market or the big stock market to identify the selling point. So it's now a springboard sell model. But over on the other side, in previous post-bubble contractions, the gold sector has done very well, where gold goes up in real terms, which reflects upon the profitability of gold mining. And in post-bubble contractions, the real price has gone up, and the gold miners do well. And of course, you will have speculative action in the golds. You've had a very good move out of November. The actual low for some stocks was in September under some pretty heavy-duty selling. But we've got a modest position, and so on the gold sector, on any of the rallies, more specifically on the dips, we have a model that would be buying the gold stocks and trading them on the long side. And then on the stock market, of course, you go the other way around and trade off of the short side from time to time. So we do live in interesting times.
We'll have more with Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, are you expecting a big bounce in precious metals?
Yeah, not a big bounce. In the precious metals, you'll get some trades in silver and gold. But in a contraction, the senior currency has been traditionally strong. So we're not looking for any huge moves in gold or silver in U.S. dollar terms. If you're in a country with a crappy currency, of course you're going to make money. But where the money be made is that there's always more of a swing in gold stocks, unless you're playing like gold futures or silver futures, in which case you run the risk of being in the futures. But more for an investment type is the gold stocks, and you'll get a bigger bang out of those than you will out of the metal. And the business will grow. In previous post-bubble contractions, like for example, Homestake was the senior producer in North America through the 1920s and the 1930s, and of course the stock went up somewhat with the 1929 bull market, but the golds were a poor performer. But it went down with the crash in $8, 8 1/8 or something it was, and then through 1930 and 31 you could have bought the stock Homestake for $9 a share. And then when it hooked up with the real price going up, the stock started to move up. And so there was no change in the price of gold. It stayed at $20.67 an ounce to the end of 1932. And by that time, Homestake from the $9 was up something like 130%, I recall. And their earnings were up about 130% as well, with no change in the price of gold. And that was due to basically their operating costs dropping. Energy costs went down. The cost of blasting agents went down, the cost of running equipment went down, the cost of labor, because many copper mines, many base metal mines shut down. Labor was not expensive. So, and then Roosevelt in 1933 began moving the price of gold up. It was a madness reason, but we can go into that at another time. And to $35, and homestake on the $9 purchase was up to about $65 in the mid-1930s. And get this, Jim, paying $4.50 a share dividend on your $9 purchase. But that's what gold miners did in those days. They dividended everything out because it was cash. Whereas this time around, the gold miners will do well, but I think they would be more interested in building assets, whichever way they can, takeovers and stuff like that, new discoveries, rather than paying out cash. That was just the way the gold business ran then. So I'm looking forward to it, and it'll also be, you can see where improving earnings make the gold sector companies attractive, but for producers, but also any any gold deposits, the valuations on those would be improving as well. So there'd be a very good speculative market for exploration stocks, which is a sector I've always liked because that's what I started in. I took a degree in geophysics and then went in, well, it gave me great summers in mining exploration work. And then a full winter working in the bush wasn't to my taste, so that's then when I moved over into the investment business. But I do like the exploration side.
Dancing with grizzly bears.
No, but I ran into black bears in the bush, and it scared the hell out of me a couple of times. And I do know a geologist who was attacked by a grizzly and survived.
Yeah, it's a tough business.
Yeah, bears are not good.
Bob, thank you so much for chatting with us.
Good to be with you, Jim, and we look forward to next week.
Your real experience with a bear market. My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.